Good afternoon. Welcome to the first meeting of the Bills Committee on Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups, Bill 2024. First item on the agenda, election of a deputy chairman. So this is the question to be considered in accordance with Appendix 4 of the House Rules. It's for the Bills Committee to decide whether to elect a deputy chair. At the close of the nomination period, the Bills Committee only received one valid nomination, so nominated by Mr. Adrian Ho for Mr. Edmund Wong and seconded by Mr. Rock Chen. So do we need to elect a deputy chair? Right. If this is so agreed by members, then I declare that Mr. Edmund Wong is elected Deputy Chair for the Bills Committee on Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. We have a small conference room today, so at the next meeting where there is more space, I will invite the Deputy Chair to step up to the platform and join us. Let's invite the administration to come in first. Now we're joined by Mr. Andrew Lai, Permanent Secretary for Financial Services and the Treasury, Mr. Benjamin Chan, Commissioner for Inland Revenue, and their team. I won't go through the attendance list in detail. Now, the Secretariat received one written submission before the start of the meeting, and the written submission has been forwarded to members since the 27th of January. We've also referred this letter to the administration for a response. So this response is pending. Permanent Secretary, when you're ready, do give us your response. My next question for members is whether it is necessary to invite public views. Should we hold a public hearing, or should we receive written submissions only? Right, there being no objections, I think that we agree that written submissions should be invited. And a notice will be published on the LegCo's website to invite for public views. We'll also circulate this invitation to the 18 district councils. So without further ado, we will proceed to the meat of the meeting, that is about the bill. I will invite the administration to walk us through the bill first. Who will lead us through that? Mr. Lai, Permanent Secretary. Thank you. Let me wish everybody a prosperous and happy new year in the year of the snake. I will brief members on the details of this bill relating to minimum tax for multinational enterprise groups. Now, this seems to be a rather heavy bill. It contains more than 200 pages, but in fact, it's not really complex. Together with the Commissioner for Inland Revenue, we will explain to members the objective of this amendment bill and also the major elements. So in our presentation, we'd like to walk members through some key concepts. Now, I will first explain to members what BEPS 2.0 is about, along with the policy objectives and Hong Kong's position and strategy. Now, the Commissioner will walk members through the key features of the bill as well as the key elements of the Global Minimum Tax, or GMT, and the Hong Kong Minimum Top-Up Tax, or HKMTT regimes. We will also explain our workflow. So, what is BEPS 2.0? BEPS refers to base erosion and profit shifting. Now, against the backdrop of a digital economy, multinational enterprise groups, or MNE groups, tend to shift profits to low or no tax jurisdictions to reduce tax liabilities. In 2021, the OECD put forward the BEPS 2.0 framework to address the issue of tax evasion among MNE groups. And so far, over 140 countries and regions have signed up for the framework, including the mainland and Hong Kong. Now, you may have this question, why the OECD should take forward BEPS 2.0. In fact, in the past decade or so, OECD has put forward a lot of initiatives to combat tax evasion by major multinational groups. For example, about a decade ago, introduced the automatic exchange of tax information. Major financial institutions, banks, enterprises are required to identify tax residents, and the relevant tax information will be submitted to the relevant jurisdictions and their tax authorities on a yearly basis. And upon receiving the information, these authorities could go after those committing tax evasion. Now, the framework proved to be a success. So later on, it introduced BEPS 2.0 framework to deal with a transfer mechanism, because some enterprises would resort to accounting tricks, and that profits would be transferred to low profit earning subsidiaries from the parent entities, and then the parent entities would be able to pay much less in tax. So for those harmful practices, the OECD requires the relevant entities to be considered as independent entities, and that no taxation arrangements that would bring benefit to the parent entities could be put in place. Now, on this occasion, for multinational enterprise groups earning annual consolidated revenue of more than 750 million euros, then these groups will have to pay at least 15% in tax as a minimum tax rate. Now I turn to the next slide to explain the definitions. For multinational enterprise groups, they refer to groups that operate in different jurisdictions. So they have businesses all over the world. Now for the groups with effective tax rate in the jurisdictions lower than 15%, then they will be required to pay the global minimum tax of 15%, and that's the difference between the minimum tax and the ETR. So the framework targets MNE groups with annual consolidated revenue at or above 750 million euros in at least 2 of the 4 fiscal years immediately preceding the current fiscal year. For the in-scope groups, they have to calculate the effective tax rate, or ETR, in each jurisdiction in which they operate and pay the top-up tax if the jurisdictional ETR is below 15%. So that's at least 15% in terms of tax rate. Now, different jurisdictions may have different approaches to demanding that top-up tax be paid. For example, in the past 4 years, for a large MNE group, if it has a consolidated revenue of over 700 million euros in at least 2 or the 4 of the 4 fiscal years, and if the group in Hong Kong enjoys a tax rate of below 15%, then upon passage of the bill, the Hong Kong Tax Authority will be having this right to collect the top-up tax from the group's constituent entities. Now, we go by 2 rules. and that's the income inclusion rule and the undertaxed profits rule. The Commissioner for Inland Revenue will explain these two interlocking rules in greater detail later. So basically, this is how the BEPS 2.0 framework works. So now another question may pop up in your mind. Now that's the OECD's proposed framework. What happens if we don't follow the framework? So I turn to Hong Kong's position and strategy. We explain what our stance is. First and foremost, Hong Kong is an international financial center, and this framework is for anti-tax avoidance or tax evasion proposed by the OECD, and major economies and entities around the world have signed up for the framework. So in terms of Hong Kong's reputation, there is no reason why we shouldn't join the framework, because we don't want any speculation about Hong Kong being a tax haven. Now, some may say that good reputation aside, what's more important is whether this will bring benefit to Hong Kong. Now, if we introduce this framework into Hong Kong, if it eats into our revenue, then perhaps we should just set the reputation issue aside. But as I explained, over 140 countries and regions have introduced the framework. Now, as explained under the framework, if we do not join as a member of the framework, then the other eligible jurisdictions may charge the top-up tax on behalf of Hong Kong. So in other words, if we still go by a tax rate below 15%, then other jurisdictions may charge tax to the constituent entities having operations in Hong Kong for the top-up tax. So we do believe that we should join everyone in implementing the BEPS 2.0 framework. According to our preliminary view, after implementing this bill, if we take a look at the financial statements of MNE groups in the past 2 or 3 years, about 200 such groups may hit the threshold and may be required to pay top-up tax, and that will translate to additional tax revenue of $15 billion. So you may regard this as an additional benefit. But let me also explain that this framework should not affect 99% or 99.9% of enterprises in Hong Kong. It only targets 1%, and this 1% refers to, first of all, multinational enterprise groups, and second of all, those groups with the annual consolidated revenue at or above 750 million euros in at least 2 of the 4 fiscal years. So for an MNE group or for an enterprise in Hong Kong earning 100 billion of revenue each year, as long as they do not have businesses abroad, they should not be affected. And for MNE groups operating in Hong Kong with less than 8 billion Hong Kong dollars of annual consolidated revenue, they won't be affected either. So only 1% will be affected. It is also our strategy in implementing the framework that we should practice pragmatism. We don't seek to go beyond what our competitors are doing. We are not getting ahead in terms of introducing this framework, and we are not jump-starting in order to charge top-up tax earlier than other jurisdictions. That's not our intention. In fact, we are among the last batch of countries implementing the framework before the deadline. But because, as I explained, if we do not implement this framework in time, then other tax jurisdictions will be able to scoop up the top-up tax on our behalf. Now, since the 15% global minimum tax initiative will be introduced across the board among all the countries, we should enjoy an even greater edge in the future. And I'm referring to competition among different economies in attracting the MNE groups to start their businesses in the jurisdictions. And that is the purpose of the OECD framework. This issue should be addressed to provide a level playing field. If across the board a 15% GMT is introduced for all entities, all economies, then we can then give play to our other competitive advantages, such as being an international financial center and having the backing of our motherland, etc. So we see this as an opportunity to sharpen our edge. We're not concerned about our competitiveness being eroded. I will now give the floor to Mr. Chan, Commissioner.
Thank you, Chair. Thank you, Permanent Secretary. I will now talk about the key features of the bill. For the specific provisions, we will go through them in the clause-by-clause examination. So, as said earlier, the bill may seem long, but we have only added one part and 4 new schedules. So the new part is Part 4AA. This part mainly provides for the charging of IRR top-up tax and the UTPR top-up tax, as well as the Hong Kong minimum top-up tax HKMTT. It also includes some anti-avoidance provisions. We have 4 new schedules. We have first Schedule 60. It would replicate the OECD Globe Model Rules. The OECD for the minimum top-up tax has some model rules that were promulgated in 2022. For a jurisdiction that is to implement the framework, the jurisdiction must follow the model rules. So in order to conform to these rules and to make sure we'll meet the requirements in the peer review process, we have chosen to replicate the model rules in the schedule. We have only made some necessary changes, and these are changes in response to the requirements of the OECD. Otherwise, if not for such requirements, we would have replicated the whole of the model rules. We have also provided for some safe harbors, and I will go through the details later. That's Schedule 60. On Schedule 61, it has a framework for the HKMTT. Schedule 62, administration details of the top-up taxes. Schedule 63 lists out the commentaries and administrative guidances of the OECD. So we have listed them out basically, and the specific sections. These are all included in Schedule 63. The OECD would also make changes to the commentaries and administrative guidances from time to time. For example, just last year, they have made multiple changes. In order to allow swift adoption of the updated commentaries and administrative guidances, because we are to follow the requirements of the OECD, The Secretary for Financial Services and the Treasury may by notice publish in the Gazette amend Schedules 60 to 63. In the following, I will talk about the key elements of the GMT and HKMTT regimes. First, the scope. As I said, or as the Permanent Secretary explained earlier, these would apply to MNE groups with a consolidated annual revenue of 750 million euros or above in at least 2 of the 4 fiscal years immediately preceding the current fiscal year. As for the top-up tax, as said earlier, if an in-scope MNE group, their effective tax rate is lower than 15% in a jurisdiction, they may be charged top-up tax. So what is effective tax rate? You may see effective tax rate ETR does not mean the effective tax rate for the whole group in the world. It also is not the effective tax rate for each entity. It is jurisdictional based. So we will calculate the effective tax rate for the entities in the jurisdiction. Basically, it would be the sum of the expenditure, and then it would be divided by the total profit. So basically, for an MNE group, they may have multiple constituent entities in a particular jurisdiction. So we would sum up the tax rates, and then we will sum up the total profits, and the sum of the tax rates would be divided by the sum of the total profits to derive the ETR. So you may observe that our profits tax rate is supposed to be 16.5% for an enterprise. So why is it that the ETR may not reach 15%? It is because they would include in their calculations the actual taxes paid. So for the actual taxes paid, that is the sum that are to pay in the tax assessment. But then the total would actually have to be the figure in the financial statements. And many of them won't be charged taxes in Hong Kong, such as offshore income. For example, dividends. Most dividends would not be chargeable to tax, which is why the ETR is often lower than 15%. So for the MNE groups, for this reason, they may be charged top-up tax. Under this bill, the top-up tax will be deemed as profits tax. Why are we adopting this approach? There are 2 reasons. One is for convenience of enforcement. Right now, we have in the Inland Revenue Ordinance many provisions relating to the profits tax. For example, we have an objection and recovery mechanism. These provisions have been quite effective, and many taxpayers are already quite used to them. So we think it is better to adopt the approach of charging top-up tax as a part of profits tax, so we do not need additional legislation for enforcement and implementation. Now, for another reason is for cross-border enforcement. We would have many jurisdictions implementing the framework. So we may see some cross-border disputes in future. The OECD has yet to decide on whether to put forward a mechanism to resolve disputes relating to the BEPS 2.0 framework. Therefore, we think there is a need in the meantime to have a mechanism to resolve disputes. And we have some CDTAs in Hong Kong And we cover only 3 classes of taxes: property tax, salaries tax, and profits tax. So if we treat top-up tax as a part of profits tax, we can rely on the CDTAs to resolve certain disputes. Let me now talk about another concept that will be relevant. That is the location of the MNE constituent entity. As I said earlier, the ETR will be calculated on the basis of jurisdictions. And for the constituent entities, their taxes paid and their total taxable profits will be relevant in a particular jurisdiction. So it is important to determine the location or consider the location of the MNE constituent entity, because it would factor into the calculation of the jurisdictional ETR. And according to the OECD, it would be based on the tax jurisdiction of the entity. But right now in the Inland Revenue Ordinance, we do not have a specific definition for tax residents, because right now in Hong Kong, we are making use of the territorial principle of taxation. We do not follow the source in particular where the income is derived, because there is no need. Therefore, there is no need to include a definition for tax residents. In order to implement the framework, we will introduce a definition of Hong Kong resident entity, and that is to implement this specific initiative for general tax purpose. We also suggest that this definition should have retrospective effect from 1st of January 2024. Why is that? Because we hope that through this, for some Hong Kong incorporated companies, for the whole of 2024, they will be regarded as Hong Kong resident entities. The benefit to this is the location of MNE constituent entities would rely on where the jurisdiction is. So say if a company is incorporated in the UK, but their management and controls would be done in Hong Kong. If we do not have a definition of Hong Kong resident entity, in accordance with the globe rules, the company would be considered to be based in the UK. And the UK is to calculate the effective tax rate. Or if it is a parent entity, or it has a parent entity in the UK may charge top-up tax to the entity. But then the problem is most of the operations take place in Hong Kong, and if Hong Kong does not get to charge top-up tax, it will just lose out, and the top-up tax will be charged elsewhere. So we will introduce a definition of Hong Kong resident entity with retrospective. We have many regions, the UK and many European countries, that have already implemented the top-up tax initiative. So there is a need for us to introduce this definition. I will now talk about the different rules. That is the IIR, UTPR, and HKMTT. How they will affect the in-scope MNE groups. To put it simply, these in-scope MNE groups, Hong Kong constituent entities, which are the entities that will be affected. There are only 4 classes. So one, it has to be an in-scope Hong Kong headquartered MNE group with Hong Kong constituent entities. The other class would be that we have foreign headquartered MNE groups with Hong Kong constituent entities. We also would have some Hong Kong headquartered MNE groups with foreign constituent entities that may be affected by the regimes. So there are in total, with these different combinations, 4 classes that may be affected by the regimes.
Now, there are 3 sets of rules, the HKMTT, IRR, and UTPR. These 3 rules apply to the 4 categories of constituent entities I mentioned. For the first one, HKMTT, it targets the Hong Kong constituent entities, whether or not the headquarters are situated in Hong Kong or otherwise. So the Hong Kong constituent entities of these MNE groups headquartered in Hong Kong or elsewhere may be subject to the top-up tax. The other rule is, say, if there is a parent company headquartered in Hong Kong with constituent entities in other places such as BVI, Cayman Islands, and as we know, these are no tax jurisdictions. So according to the income inclusion rule, the parent entity headquartered in Hong Kong may be subject to the top-up tax. The third rule is the UTPR. Now, we call this the backstop. When both the HKMTT and IIR fail in demanding the entity to pay top-up tax in Hong Kong tax jurisdiction, then the UTPR will kick in, and then this rule targets non-Hong Kong constituent entities of foreign headquartered MNE groups. Now, this is called the backstop because many jurisdictions have introduced the global minimum tax rate. And as a result, it is unlikely that the UTPR may be used in order to demand top tax payment. We just use it as the safety net or the backstop. I now turn to the next point, and that is the safe harbors. When certain criteria are met, MNE groups will not be required to do the calculations as required by the OECD, or they could go by simplified calculations. The purpose is to reduce compliance costs of MNE groups. Now, there are several safe harbors. There are transitional ones. In the first few years of its implementation, OECD is of the view that some time should be allowed for the MNE groups to get used to the new regime. So some measures will be put in place for MNE groups to go by simplified calculations in relation to taxation matters. We will go into greater detail about safe harbors when we examine the clauses in greater detail. For example, we have the HKMTT subject to peer review by the OECD. Once the HKMTT is implemented, we may get the qualified status, and that means the top-up tax for Hong Kong jurisdiction for the MNE groups in question may be deemed zero. This is significant in the sense that the MNE groups will be relieved of the compliance burden. They will not be required to do the calculations again to see if top-up tax should be paid in Hong Kong. So this will be a facilitation measure for these MNE groups. Next, about tax administration and compliance. The rules seem quite complex in terms of reporting and administrative requirements. MNE groups will be required to submit tax information. Now, our stance is to make things as simple and practical as possible. We don't want to add on to the compliance burden. So we will do our best in aligning the HKMTT with the OECD's requirements on qualified domestic minimum top-up tax. We'll also ride on the administrative provisions of the Inland Revenue Ordinance. We will also be making necessary modifications. For example, our regime is based on profits tax, so we need to make modifications. We also want to facilitate taxpayers in their operations. We understand that these MNE groups may have businesses in different jurisdictions and they may need to file top-up tax returns in different places, maybe more than 3 at a time. Our goal is to adopt a single top-up tax return, and this can help them meet the standardized requirement. In fact, under the OECD framework, there is an obligation for GIR information to be filed and exchanged. So we will go by the exchange arrangements with the jurisdictions under this framework. Now, for the entities in different jurisdictions, they may have submitted the GIR information in the tax returns in the respective jurisdictions, and under the arrangement there is no need to file another return to Hong Kong. We can exchange tax information. Now, there are also MNE groups operating different constituent entities in Hong Kong, and there is no need for each entity to file a return. Only one entity can be they can designate that just one single entity for the purpose of filing returns. So next, on enforcement, we plan to introduce some offenses and penal provisions since taxation is involved, and we've made reference to the current regime in relation to reporting requirements. These examples include failing to file a tax return or tax notification in relation to top-up tax, etc. And we will be making reference to the relevant penalties under the profits tax regime in meting out the relevant penalties. Now, this is also an international obligation, and we have made reference to the country-by-country report in designing the level of penalties. The Inland Revenue Department has set up a dedicated team to provide technical support for NME groups and to answer taxpayers' inquiries. We will also publish administrative guidelines on the website to help taxpayers understand their reporting obligations and other taxation requirements. Now I'll give the floor back to Mr. Lai to explain the workflow. Before we introduce the bill, between December 2023 and March 2024, we launched a public consultation. We have considered the views of enterprises and also the professional sectors. We also consulted the electrical panel on financial affairs in February 2024. Members are generally supportive. Now, in drawing up the bill, we have largely taken on board as much as possible the stakeholders' views. Now, the tax cooperation regime is formulated by the OECD. And the OECD has also formulated the BEPS 2.0 model rules. Basically, the jurisdictions draw up their respective regimes on the basis of the model rules. The model rules are put in place to avoid loopholes being exploited. And as I explained, after enacting the legislation, the framework will be subject to a peer review by the OECD. They will check our framework against the model rules. Then that means there may be some necessary modifications following the OECD's advice. Now, in the Inland Revenue Ordinance, amendments will have to be made. We will make reference to our existing provisions in the Inland Revenue Ordinance, in particular, the parts relating to profits tax. We'll try to do things as simplified as possible. Well, basically, this bill contains more than 200 pages, but most of the content is built on the OECD's framework. Now, we tabled this bill into the Council on the 8th of January, and this is the first meeting of the Bills Committee. We hope that this bill can be passed later on this year for implementation in year 2027-28. For the global minimum tax put forward by for the under-taxed profits rule proposed by the OECD, again, we take a pragmatic stance. We are now observing the progress of other jurisdictions. We are not getting ahead of others, and we are not jump-starting anything so as to bring inconvenience or even to the business sector to Hong Kong. This is not our purpose. We've just walked members through the bill. I hope that the members have had a better understanding of the bill now. Now, in the following, the Commissioner, along with my colleagues and myself, be happy to take questions from members. Thank you. I'd like to draw members' attention to TsyB R2/2025-02, which is the Assistant Legal Advisor's letter to the administration. The administration will provide a response in due course. We now open the floor for questions. If you have questions, please press the button. We have 6 members waiting to speak. We should let everyone have a go. And that means I will give each member 7 minutes for the first round. We start with Dennis Leung, Rock Chen, Carmen Kan, Wendy Hong, Edmund Wong, and Robert Lee. Dennis Leung will kick off.
Thank you, Chair. Now, with the Hong Kong MTT regime, I believe some entities are not made applicable. One would be the investment entities and investment insurance entities. I don't see in the paper why these entities are carved out in particular. Is it according to OECD, or is it that this is the practice adopted by other regions as well? Can you provide more information on this? Also, according to the paper, once we implement the MTT regime, we will have additional tax revenue of $15 billion. How have you derived this figure? Do you think we'll have more or less in reality? We, of course, want to have at least the minimum effective tax of 15%. So in Hong Kong, we have the profits tax rate of 16.5%. With an effective tax rate of 15%, will it drive the companies to other jurisdictions? Now, we have over 140 countries or regions implementing the framework. For those who have not adopted the framework, for the parent entities in these jurisdictions, will we be able to charge the top-up tax to the entities in Hong Kong? Thank you. Permanent Secretary, I will answer the questions in relation to policy, and I'll let the Commissioner supplement my answers. The policy intent is to implement the OECD BAPS framework. For what does not have to be done, we do not plan on doing such in this exercise. So for the entities that are carved out, we have already conformed to the requirements of OECD by carving them out, basically. For tax cooperation, in relation to the MNE groups, the OECD has already requested country-by-country reporting. So for MNE groups based in Hong Kong, we have referred to their CBC reports in the past few years. We have been able to estimate how many MNE groups would be covered by the regimes in future. And if we are charging them with 15% of tax, how much we will get in tax revenue. That's how we derive our figure of $15 billion. But are we talking about actually having a $15 billion in tax revenue in 2027-28? It would have to depend on whether the MNE group is still making similar in amount in revenue. I'll now let Mr. Benjamin Chan supplement answers. Thank you, Permanent Secretary. Thank you, Member, for the questions. Why we're carving out the investment entities and insurance investment entities. For the OECD, with the qualified domestic MTT, in accordance with the OECD, we have the option to either include or exclude insurance investment entities and investment entities. When we did our consultations, we consulted especially the financial sector and insurance sector. And of course, these entities are highly relevant in the financial sector. And the sector's view is that we should exclude these entities from the HKMTT regime. That should help with our competitiveness. And for these investment entities, they may have investors that will derive income from the investments with these entities, such as dividends. If the investor itself is an in-scope MNE group, it would already be covered by the regime. And if they are charged taxes again, there may be a problem with double taxation. So we believe it is more appropriate to carve them out from the regime. Most importantly, the OECD allows this. That's why we're doing it. As for our estimation of the tax revenue, as the Permanent Secretary said, we have referred to the CBC reports of the MNE groups. The Inland Revenue Department has already been receiving such information from the MNE groups in the past few years. And they are submitting statements to us for this purpose. And with the statements, we have derived this estimate. Or as for whether we will actually get this amount of tax revenue in 2027-2028, there are several factors to consider. One, the CBC reports may show that the MNE groups getting 750 million euros in consolidated group revenue, but it may not be the case that they will have such revenue for at least 2 of the 4 fiscal years preceding the current fiscal year. So it may not necessarily be the case that they would become in-scope MNE groups. So that is a limitation, so to speak. And when we derive our estimates, we are limited by the fact that we would have complete information about the constituent entities in Hong Kong of these MNE groups. In order to derive the effective tax rate, we need to have such information. Without complete information, it is hard to derive a completely accurate estimate. We can only have essentially a rough estimate. So this is the second limitation. Thirdly, we cannot consider the factor that with MNE groups being subject to this initiative, they may make changes to their corporate structure. There may be structural changes. As I said earlier, there may be other arrangements in response to the measure. With these potential changes, it may be the case that we would have a lower tax revenue than estimated here with this $15 billion figure. So these are the factors that may affect our potential tax revenue. As for whether that will affect the groups or other groups' incentive to base their operations in Hong Kong, I think there are many factors to consider. But let me say this, even with the implementation of the framework, we are targeting only large-scale MNE groups. We are talking about groups with a consolidated group revenue of 750 million euros. And with such large-scale operations, it is more than likely they already have operations in other jurisdictions that are implementing the BEPS framework, such as Japan, South Korea, Singapore, the UK, and other European jurisdictions such as Switzerland. So with such a large-scale MNE group, it is more than likely they would have operations in one of the jurisdictions that are implementing BEPS 2.0 framework, and in accordance with the OECD's rules, as long as they have operations in any one of these jurisdictions, they will be charged top-up tax, whether in Hong Kong or not. So it is more than likely they would be covered. So So it is unlikely that they will move out of Hong Kong because it's hard for them to avoid being charged top-up tax with such large-scale operations. We would think it is disadvantageous if we do not implement the framework for these jurisdictions. They would need to not only pay the top-up tax in other jurisdictions, they may have to do a lot in terms of reporting. There may be high compliance costs involved. They may not necessarily benefit from this. With this top-up tax initiative, we still have a profits tax rate of 16.5%, so this is quite low compared to other tax jurisdictions. What are the jurisdictions that are most affected by the initiative? It would be those that do not charge any tax, that is BVI or Cayman Islands. So with companies based in BVI or Cayman Islands, they may no longer have the benefit of avoiding taxes. So they may consider moving. They would most likely move to Hong Kong because Hong Kong only has a tax rate of 16.5% compared to 20 to 30% in other European jurisdictions. So with the implementation of this initiative, it would be the case that we would essentially benefit from this. Commissioner, I think everyone is nodding, so everyone understands. So for the last question, can you briefly talk about if we do not implement the framework, what will happen? Well, I have already given an answer that touches on this issue. So for MNE groups that have operations in any one of the 140 countries or regions that implement the framework, they would already have to be charged top-up tax. So if Hong Kong does not implement that, it would actually cost the companies in compliance costs. Thank you. Mr. Rob Chen. Thank you. We are following the globe rules when calculating these top-up taxes. We have received views from some professionals that we may have rules that kind of deviate from the model rules. So can you clarify that our approach to calculations, whether it is inconsistent with the approach taken by the OECD? My second question is in relation to the paper submitted. So the IRD on some occasions may accept reports that do not conform to certain requirements. So we are talking about 311/2022/02. So for those that do not comply with the requirements, can you explain what that would entail? And I believe it's paragraph 6 in that paper. Mr. Chen. Thank you, Mr. Chen, for your question. On anti-avoidance provisions. You may see in the provisions, we have a requirement that for the bill's provisions, they should be read along with the guidances and commentaries of the OECD. Basically, even if we are to enforce the anti-avoidance provisions, we must follow the requirements of the OECD. So we cannot work beyond the framework. So we are limited essentially by the requirements of the OECD. We do understand there are some concerns expressed by professionals that there may be inconsistencies. During our consultations, we have considered feedback from various sectors. We talked about relying on only the anti-avoidance provisions in the Inland Revenue Ordinance, and the feedback that we got was the provisions were inconsistent with the OECD requirements because there are two different systems. So in response to feedback we got, we have some new anti-avoidance provisions. We would adopt a main purpose test. So this is not the first time that this has been adopted in tax legislation. We have adopted this test in other tax-related legislation in Hong Kong. That's why we have chosen to adopt this test. We also understand that with this bill, we have got some feedback, and we have been communicating with the relevant sector. And if necessary, we'll make some adjustments. But I hope members would understand that there is a need to implement anti-avoidance provisions, because we have been discussing with the OECD Secretariat when implementing the framework whether we need to include anti-avoidance provisions, and they said it is necessary because we have a complex system here. And we are at the beginning stage of implementing the framework. We may see companies change their ways to avoid paying taxes still. So we need some general anti-avoidance provisions, but on top of that, we would need some additional tax avoidance provisions, and these will be considered in the peer review process. If we have instances of tax avoidance, we need to make sure in our tax system that we have ways to deal with that. That's why we need general anti-avoidance provisions. As for the way of drafting, we are more than willing to adapt it with reference to industry feedback. For the second one,
Yes, Ms. Lam? Assistant Commissioner. Now, the member asked about the specific circumstances in the top-up tax return. Now, in the bill, we require MNE groups to file top-up tax return electronically. Under some circumstances, we could allow for the filing of the top-up tax return by the constituent entity in a non-electronic manner. But we're talking about some unique circumstances. For example, after passage of the bill, the groups will be required to file the top-up tax return in June 2027 earliest. But there might be some circumstances arising from the situation of the group. For example, it may be in the process of liquidation, and that in some very special circumstances before the launch of the electronic system by the IRD, the Commissioner may allow for the tax return to be filed non-electronically. Next, Ms. Carmen Kat. Thank you, Chair. Chairman, I appreciate the administration for walking us through in great detail this rather complex bill. Now, my first question is about the possibility of, say, a flowchart or some pictorial illustration. You've given us things in black and white, and you've explained about the four categories: Hong Kong headquartered group with Hong Kong constituent entities and non-Hong Kong constituent entities as well as foreign headquartered parent entity with Hong Kong and non-Hong Kong constituent entities. I'd like to have a chart. Give us a table or a chart with the 4 columns to help us better understand how different rules apply to these entities. And I fully support the purpose of the bill to safeguard our taxing rights. Top-up tax will be charged by other jurisdictions if not by us, according to the OECD requirements. Now, I'd like to turn to what the assistant legal advisors point in the letter. And that is to say, in our tax regime, we do not have a definition of a tax resident or a resident because we adopt the territorial source of taxation principle. We do not have the definition of a Hong Kong resident entity. Now, I believe this is not unique to Hong Kong. There are other places adopting the same principle as well. But because of the introduction of this framework, you need to drop this definition. This will have a retrospective effect of the 1st of January 2024. You explained that the purpose is to protect these MNE groups. I just want to know whether the process is accepted by the OECD. I want to know, say, what happens at the stage of the peer review. Do we have similar examples adopted by other jurisdictions? Now, about the bill. Broadly speaking, it will come into effect on the 1st of January 2025. That means it has retroactivity. Is it true? Commissioner Chan. Yes, we can give you some graphic illustrations later on. About the retrospective effect of 1st of January 2024 for the definition of Hong Kong resident entity, we made inquiries with the Secretariat of the OECD. We have sought their confirmation that this approach is appropriate. Say, there are provisions which set out that the approach should there be changes to the status of the company. And the OECD has this provision to allow for the change of the status of the entity with retrospective effect. In other words, likewise, our provision also will be deemed appropriate, and that starting from the 1st of January 2024, subject to meeting certain requirements, the company will be deemed a Hong Kong tax resident entity. But as we understand, different jurisdictions have different considerations. The OECD, however, is the organization in charge of this framework, and we do find it appropriate to go by the interpretation of the OECD. Now, about the effective date of the provisions in the bill, and that they will come into effect on the 1st of January 2025 as the start of the financial year. In fact, we previously had different amendment exercises involving the Inland Revenue Ordinance, adopting the same approach. In 2018, for example, about the country-by-country report and the reporting requirements. Likewise, in that bill, we introduced provisions that would allow retroactivity to the 1st of January 2018. There should not be a significant impact on the relevant sectors because the Financial Secretary already announced in last year's budget that in 2025 we will introduce the minimum tax for multinational enterprise groups in Hong Kong. And during the consultation, sessions, we already explained to the sectors our implementation timetable. So be it the time frame of the bill or deliberation process with the sectors, we believe that the sectors are fully aware of the requirements. And we understand that the MNE groups have been making a lot of efforts to prepare themselves for the new requirements. So as far as the sectors are concerned, there shouldn't be any major problem. That means especially in relation to the retrospective effective date of the 1st of January 2025. Right, I just want to put it on record in this Bills Committee that you have already inquired with the Secretariat of the OECD. Now, we haven't touched on the issue of peer review. So perhaps after this round of questions, the administration could explain to us, upon conclusion of the legislative exercise, when actually will the peer review begin, and whether some other jurisdictions have undergone the peer reviews, and what conclusion can you draw from that? My last question is this. We are also enacting another piece of legislation on redomiciliation, and the Bills Committee will be in action very soon. Now, I wonder if the administration has considered both bills side by side, that is redomiciliation regime and BEPS 2.0, and whether any measures can be introduced to make Hong Kong an even more attractive place for these entities to be redomiciled in Hong Kong, since those tax havens will no longer enjoy an edge in the future, so as to safeguard our taxing rights. Yes, well, thank you, Ms. Carmen Khan, for the questions. Indeed, apart from this minimum tax for MNE groups, another bill is being drawn up in relation to the redomiciliation regime. And as I answered Mr. Dennis Leung's question just now, these are related. On the one hand, we are fulfilling our obligations to meet the OECD's requirement of introducing a 15% global minimum tax rate. So since these entities will be required to fork out money up to 15% of the tax rate, then it may be a more favorable arrangement to stay in the regime that they are familiar with and pay tax to the inland revenue in Hong Kong. Now, the purpose of the OECD's global minimum tax regime is to reduce harmful tax competition. So that means a race to the bottom tax rate competition will no longer be possible. On the other hand, against this backdrop, if we're able to put in place facilitation measures for companies to be redomiciled to Hong Kong, then we may enjoy an additional edge. Of course, it's up to the companies at the end of the day to decide whether to be redomiciled here. But if we create a more favorable business environment for them, then definitely it will bring more benefits to Hong Kong as an international financial and trade center. So even without the OECD's minimum tax initiative, we have these ideas in mind. The details will be discussed by the relevant Bills Committee in due course. Dr. Wendy Hong, I support the OECD's effort to introduce a global minimum tax rate, but I have a number of questions for clarification. Many economies would have special measures to support the relevant industries in the form of preferential tax treatments. For example, in Hong Kong, we provide tax concessions to aircraft leasing, ship leasing, etc. Last year, we also passed a piece of legislation in this council to provide tax incentive for patent box. Now, for MNE groups earning more than 750 million euros per year, does it mean that they will not benefit from it? In other words, can you explain to us, comparing to other jurisdictions that have measures to support some particular industries, can you explain in greater detail what our approach is? The second question is about implementation timetable. Now, it will be effective. I mean, the retrospectively on the 1st of January 2025. Now, but you also explained that some countries have a different implementation date. Can you explain to us why we're not on par with other jurisdictions?
Thank you, Dr. Wendy Hong, for your questions. On when we chose that particular date to start implementing the framework, the Commissioner will explain that later. I think Dr. Wendy Hong said correctly that the administration has introduced various measures facilitating the operations of various industries, and these would include concessionary tax treatments for aircraft leasing managers, aircraft lessors, and some relating to income derived from the IP. But the thing is, this is allowed by the OECD as long as we are fair to both local and overseas enterprises. And for our existing concessionary tax treatments for operations in Hong Kong, these tax treatments would be made applicable. So this is conforming to the OECD's requirements still. Let me confirm also the existing concessionary tax treatments will continue to remain applicable after we have implemented the BAPS 2.0 framework. And as said earlier, the minimum top-up tax regimes will only apply to in-scope MNE groups with a consolidated group revenue of 750 million euros or above. And I believe this would not affect their operations, but I'll let the Commissioner explain the details of operations later. Thank you. Commissioner, as the Permanent Secretary said, we have various concessionary tax treatments in Hong Kong for specific industries. So for those benefiting from concessionary tax treatments, if they are indeed in scope MNE groups, they may be charged top-up tax. But the emphasis is on may, because with the calculations of the top-up tax, we have to calculate the ETR effective tax rate, and that is jurisdiction-based. Basically, it wouldn't be calculations based on the entire group or the specific entities. So if one has 10 or 100 entities that do not benefit from any concessionary tax treatment in Hong Kong, so the concessionary tax treatments may not be affected in any way for most of the entities of these groups. So say there may be an entity of a group that will be dealing in aircraft leasing business, and the company itself may work in banking, and they have many entities that deal in other business that do not have any concessionary tax treatments. So it may not be the case that with the concessionary tax treatment, they will be automatically charged top-up tax. It is only when the effective tax rate is less than 15% that they will have to be charged top-up tax. And as Dr. Wen-Ti Hung said, the commencement date was 1st of January 2025. So only profits of this year would be chargeable to MTT or GMT. So the member asked whether for some jurisdictions that have already implemented the framework in 2024, we would be ceding our taxing rights to the other jurisdictions. Indeed, it may be the case, but it may not be significant. Let me explain why. Because for companies headquartered in Hong Kong, so for MNE groups with headquarters in Hong Kong, the IIR would already apply to operations in Hong Kong if for the entities outside Hong Kong, whether there may be rules that would apply that would be chargeable to top-up tax, but we only can rely on UTPR at the moment. But UTPR rule in general is adopted only after 2025 with our review of the practice of other jurisdictions. So we believe with the commencement date of 1st January 2025, it would be an appropriate timing that we would not be ceding taxing rights. So unless a jurisdiction has adopted UTPR in 2024, but we have not seen that happen so far, so we believe that we will not be ceding taxing rights to other jurisdictions. Thank you. Mr. Edmund Wong. I think the explanation of the administration is quite clear, and we have been implementing a simple low tax regime, although I do think there is some argument about whether we are indeed implementing a simple or low tax regime. When we are calculating accounting profit, we may need to calculate the effective tax rate with reference to tax expense, and it may be the case that in future that may fall under the charging section. So we do not tax capital gains or many sources of income in general. How can we tell companies or promote to them essentially that we will not tax capital gains outside Hong Kong, but then we may charge top-up tax to make sure we conform to the rules of the OECD? So what is the administration's publicity plan? Well, I think for the colleagues who are interpreting this, it may be hard for them to interpret the English version of it in time. So can you stick to Chinese? I understand it may be difficult because most of it is in English in the financial sector, but please just stick to Chinese when you're speaking. Thank you. Sure. All right, Permanent Secretary. We intend to continue to maintain a simple and low tax regime, and we also continue to maintain the territorial source principle of taxation. We do not tax dividends. And this is the approach that we're taking for all companies. It is just that we are trying to conform to the OECD requirements for we would say a minority of the MNE groups, that when we are conforming to the requirements, we need to make sure we need to calculate the effective tax rate to make sure there should be a global minimum tax of 15%. These are special arrangements, and let me say again that we are not proactively trying to charge more taxes. It's just that we are trying to implement a defensive measure in the sense that since this top of tax is going to be charged elsewhere, why not charge it ourselves? And as I said earlier, only 200 MNE groups in Hong Kong may be affected for SMEs, startups, or companies with a consolidated group revenue of less than 750 million euros or above. They would not be charged top-up tax. Commissioner, you would like to follow up, or are there any follow-up questions from Mr. Edmund Wong? Oh, I'll let the Commissioner speak first. All right, thank you. As the Permanent Secretary said, we do not target offshore income or capital gains with this initiative. It's not the case that we are now changing our approach and we're now taxing capital gains. We all along do not target derived income. We are just targeting, well, basically the bulk of income with this. So it's not that we're introducing new taxes with the implementation of the BAPS 2.0 framework. As for the territorial source of revenue, we would see this to be an exception. Before, in Hong Kong, we have exceptions in the Inland Revenue Ordinance. As you may remember, Mr. Edmund Wong, 2 years before this, we have tax exemptions for foreign source income. So that is a foreign source income exemption, and that is exactly an exception. We are just trying to conform to the OECD's latest requirements with this bill's provisions. So we continue to adopt the territorial source principle of taxation, and we will not tax capital gains. But there are exceptions. And the exception, one of the exceptions being, we have to conform to the latest taxation requirements of international bodies. We are not targeting two sources of income with new tax initiatives. Please understand this. I understand what the Commissioner is saying, and I also understand what the Permanent Secretary said about how some tax treatments would still be made applicable. But then we are talking about how Hong Kong has a deep harbor and Hong Kong has a simple low tax regime, and arguably it is no longer a simple or low tax regime. I am kind of worried how we can continue to promote our competitiveness to enterprises in general, that we still have a welcoming business environment. We do have some facilitation measures, but this would come after. We need to plan in advance how we can compete with other jurisdictions. With the same starting point, we need to make sure we are attractive to companies. And the Commissioner talked about how we would provide administrative support, but it's just about how we can support the companies to comply with the requirements. We do want additional facilitation measures, and I want to hear from the administration more information on this, because it seemed that they only talked about their policy intent. Thank you. Permanent Secretary, I would like to thank Mr. Edmund Wong for putting the questions. With the minimum top-up tax regime, it does not change the basics of our tax system. Hong Kong's simple and low tax system remains intact. We do not introduce new taxes. We are only trying to conform to OECD's requirements for tax cooperation, and we have incorporated the globe model rules in our legislation. And this is what many jurisdictions are doing. So we have many jurisdictions incorporating the same rules in their legislation. So we are not losing out in any way. On the other hand, if we are achieving the intended effect of preventing tax avoidance for the jurisdictions that have been trying to compete by charging very low or no tax, these, for the companies incorporated in these places, they would still be charged top-up tax in other jurisdictions. And on the premise of charging profits tax at 16.5% with our hardware and software advantages, with the staunch support of the country, with our sound system, we should be quite competitive. And for MNE groups, as said earlier by the commissioner, they may look at moving from jurisdictions that currently offer very low or no tax rate. They may consider moving to other jurisdictions, and Hong Kong can be quite competitive in that regard. I think Hong Kong may be having better conditions than ever before. Mr. Robert Lee.
Right, we're discussing this bill, Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. Now, broadly speaking, I support this bill. We need to align with international standards. This framework is joined by 140 countries and regions. As an international financial center, it is just right for us to join the framework as well. But I also agree with the administration that we don't need to get ahead of others. We just need to align with international standards, and that's all. And this is what I want to emphasize as well. Now, at the panel on financial affairs, you already explained the latest situation to members. Now, I'd like to pick up on this. I have some questions for clarification. Now, I fully appreciate that this bill targets large MNE groups with an annual consolidated revenue of 750 million euros. What about some other companies not regarded as MNEs? They may be in possession of certain assets in the long term, and once realized, the assets could generate a lot of profits for them. Now, under the top-up tax regime, under this new regime, will it be possible that all of a sudden these companies will be facing a huge tax burden? Are there ways to help them? Now, we have companies owning some assets for decades, and all of a sudden they may be sought after in terms of the tax regime. Now, I'd also like to pick up on what Edmund Wong said, because apparently the advantage enjoyed by Hong Kong is the low tax regime. Now, we just talked about the capital gains tax, the dividends tax. Now there is the need to meet international and OECD requirements. Now, I understand that this exercise does not target anything relating to investment, but say at the end of the day, regardless of the jurisdiction, because of this framework, some companies operating some funds or having some investments may be within scope as well. Have you conducted any assessment? Because like you said, some 200 entities in Hong Kong may be affected. Well, of course, we have our unique advantages. My question is, have you conducted any assessments? Is it possible that since they will be handed the same tax bill in another jurisdiction anyway, that there may be a risk of these enterprises moving their businesses elsewhere to minimize exposure? Can you explain these points to us? Commissioner. Right, let me take the member's question about assets. Now, some enterprises hold assets, and they have been doing so for a long time. And as I understand, the question is about the realization of the assets and whether the profits will be subject to the new framework. As I understand, the framework relates to the total revenue of the group. So, to take your point, if the asset is realized and profit is thereby generated, then the profit becomes part of the gross profit or the total profit. And this means the profit in question will be eligible for profits tax calculation. And it is possible that the top-up tax will have to be paid. However, there are also provisions in the OECD model rules to minimize the exposure to top-up tax by these entities. There are two ways, in short, to minimize the chance of the enterprises paying the top-up tax. For example, in the model rules, there are provisions. Say if in preparing the financial statements, the company adopts the approach of an asset base instead of a market value based accounting, then if the company then sells the asset and if profit is thereby generated, then in terms of calculation of the top-up tax arising from the profit, only the portion of increase in value between the effective date of this bill to the date on which the asset is sold will be eligible. So, in other words, for a company holding a property for decades, for example, if you go by this approach, that is a market value based approach, then you'll be able to minimize your exposure to top-up tax. There is also another way to go about this. For example, when you sell a property, you may not directly hold this property in the first place. You may be selling a company that holds the property. Now, if you hold this company which holds more than 10% of shares, then the profits arising from your sale of this company will not be counted towards the calculation of the top-up tax. So in other words, if you sell this company, in fact, you'll be in a better position to avoid this top-up tax because you won't be directly selling the property. Now, to answer the second question, I think this is the same as the point made by Deputy Chair Mr. Edmund Wong. For the 200 MNE groups that may fall within scope, how do we make sure that we still enjoy the competitive edge? As explained by the Permanent Secretary just now, many jurisdictions have put in place the global minimum tax. So our position is this. We do not believe by implementing the framework we will be faring worse than other jurisdictions, because other jurisdictions have also put in place the same framework. Now, regardless of the place of domicile of the companies, as long as they are within the 140 countries and regions already have already signed up for the framework, then we do not think that our competitive edge will be lost. I think that we're talking about the same point, that is, we have a simple low tax regime. Even with the introduction of this bill, comparing to many other jurisdictions, we still have a very simple tax regime. We charge 3 types of taxes. We don't have the VAT. We do not have, say, capital gains tax, unlike other places. The Inland Revenue Ordinance is now richer in content, but after all, it's just one little book. Comparing to other jurisdictions, they have stacks of statutes about taxation. So we have a simple tax regime, and we are going to maintain that. About the 200 MNE groups, well, I think that the same rules, once implemented, will apply the same way, regardless of the jurisdiction in question. The difference lies in administration. That is why our focus is on facilitating the entities, and we'll come to that in a moment. In terms of tax administration regimes, such as reporting and the filing of tax return and the payment, we will introduce facilitation measures to lower their compliance burden. Next, Mr. Tang Fei. Thank you, Chair. I thank the PS and the Commissioner for explaining the bill to us, especially at the last meeting. I was given a very clear understanding of the bill. Because of your efforts about the development of the headquarters economy of Hong Kong, I want to know whether there will be any impact as a result of this bill. Now, as I understand, the objective of the OECD framework is to avoid harmful tax practices in order to take away the business of MNE groups from each other. Now, we want to promote headquarters economy. Apart from the 200 MNE groups that already exist in Hong Kong, will there be other measures introduced by Oasis or Invest Hong Kong? Whether publicity will be enhanced, because we have the backing of our country. We also have a lot of advantages. We have a very simple low tax regime and professional services. Now, the point is whether there are measures to be rolled out by Invest Hong Kong or Oasis, so that even with the OECD latest anti-avoidance measures, we still enjoy advantages. If you set up the headquarters in Hong Kong, you will be able to benefit. So my question is this. Whether there are supporting measures to attract enterprises to come to Hong Kong. Now, the next question is this. Last time, Mr. Lai explained to us very clearly that the most prudent approach is to adopt the OECD model rules in our local legislation, so as not to create inconsistencies. And I fully agree with this approach, as it is more prudent. Now, my question is this. does the administration have any information about any jurisdiction resorting to tricks, such as allowing back payment? That is, these jurisdictions may follow the OECD rules in charging top-up tax, and then they also have some form of refund measures to make sure that the MNE groups will not be redomiciliating in another jurisdiction as a result. I just want to know, in your deliberation process with the OECD, whether you've discussed such practices, because competition is really keen in the global arena. It's not impossible that some jurisdictions may resort to this.
Mr. Tang Fei's question is very good. We are actually not just talking about tax amendments. With the government's initiative to compete for enterprises and talents, we have often communicated with ETOs, Invest Hong Kong, and OACs on the implementation of BEPS framework and what the BEPS framework is in general, how it will affect our tax competitiveness. In fact, it will help us be more competitive. Before people would or jurisdictions would advertise by the fact that they are not charging any taxes or are only charging very low taxes, but that wouldn't work now. As Mr. Dennis Leung asked earlier, why some insurance investment entities or investment entities were carved out from the implementation of the framework. The simple answer is, since the OECD allows it, that is, allows the carving out of such entities, we would not charge unnecessary taxes, because that can dampen our competitiveness. In our publicity work, we will try to enhance internal coordination and make sure other government departments are aware of what we're doing. So, with what Mr. Tang Fei said about whether some tax rebates would be offered, essentially circumventing the OECD's requirement, this will be considered in the peer review process. And in fact, recently, a jurisdiction has some similar practices, and the OECD used it as an example to ask other members not to circumvent its requirements in this manner. The global minimum tax, it is said that it is not effectively implemented in the jurisdiction. I guess we should learn from this experience, and perhaps the commissioner can talk about how the OECD has implemented some measures to prevent such circumvention. Thank you. The OECD is very concerned that some jurisdictions may potentially circumvent the requirements through implementing certain measures that would discount the initiative of the OECD. In fact, in the peer review process, this is definitely considered. The OECD would scrutinize whether there are anti-avoidance provisions or whether there are such circumvention practices in jurisdictions. There shouldn't be any measures that would help companies circumvent the paying of top-up taxes. So we can't have jurisdictions do something similar. If the jurisdictions adopt this approach, the OECD in the peer review process would ask the relevant jurisdiction to make changes to make sure that wouldn't happen. If the jurisdiction does not do that, they would fail the peer review and they would not be recognized as a jurisdiction that is implementing the framework. So the companies, the MNE groups, would be charged top-up taxes elsewhere despite having been charged top-up taxes in that particular jurisdiction. All right, we are supposed to end our meeting at 4:30. I will extend the meeting so that we can at least finish asking the policy-related questions. Thank you, Dr. Janice Ho. We have some expert answers given. I really appreciate them. But I still have some questions. With the minimum top-up tax regime, will it increase public expenditure with our conforming to the OECD's requirements? Will there be any financial implications? In Section 26AH in your bill for anti-avoidance Part 4AA, we already have some anti-avoidance provisions, so it shows that we are already proactively preventing avoidance of taxes by the MNE groups. We have the responsibility, of course, to implement such requirements, but how will we be affected? Now, with great power comes great responsibility, but this time it's the other way round. With great responsibilities, we should have great powers. And according to paragraph 60 in the paper, it is said that it should bring the government an additional revenue of about $15 billion per year from 2027-28 onwards. Such taxation or taxing right will be lost to other jurisdictions. I think you touched on this earlier, but what do you mean in particular? So are you saying the 200 groups in Hong Kong that have a consolidated group revenue of 750 million euros or above, how do they calculate the consolidated group revenue exactly? Will there be any deductible expenses that will be applicable in the Inland Revenue Ordinance to these companies? Will there be any conflicts with the implementation of the BAPS framework? And would the OECD view differently that the deductible expenses may be essentially offering tax benefits to the companies? If there are clashes with the BAPS framework, and if there are disputes, I believe right now taxpayers have an appeal mechanism. For the OECD framework implementation, since we already have the responsibility of implementing the framework, do we have the responsibility to also deal with the related complaints or the relevant objections or appeals? Thank you. I think there are two major questions. Who's going to answer this question? Permanent Secretary. Thank you. Thank you, Dr. Ho, for your questions. We are trying to conform to at least the minimum requirements of the OECD. As the enforcement authority, the IRD will most likely be dealing with matters relating to the 200 in scope MNE groups, that is MNE groups that are earning 750 million euros or above in consolidated group revenue. As for the prevention of tax avoidance. The Inland Revenue Department already has this responsibility. This is not additional work, essentially. And when we are trying to conform to OECD's requirements, the Inland Revenue Department would just deploy internal manpower to deal with the work. As Dr. Junius Ho said, in order to help companies adjust to the implementation of the framework, while we do incorporate the globe model rules, we are relying on existing legislation for the administrative arrangements. Dr. Junius Ho's understanding is quite correct. With tax assessment, should there be disputes, the current appeal mechanism would still apply. I'll let the Commissioner talk about the details of operations. I will give a brief response. Dr. Junius Ho mentioned the potential additional revenue of about 15 million, how we derive that figure, and we touched on this earlier. We basically would look at the country-by-country report submitted by the MNE groups in recent years, and that would include their tax expenses and revenues elsewhere. With such information, we have derived the estimate. As for the OECD rules, whether it would clash with the current approach we adopt for calculations in the Inland Revenue Ordinance, they are indeed different. Because the globe model rules apply to the 140 countries or regions that are implementing this framework, we have the globe model rules. But then for the globe model rules, because they were derived with different practices in different jurisdictions in mind, it may not be entirely consistent with Hong Kong's tax system. But is it that different? Not really, because with income taxes, there are many similarities in the taxing arrangements. As the Permanent Secretary said, in future, should disputes arise, if it is just disputes relating to tax assessment, we'll rely on existing provisions in the Inland Revenue Ordinance. But for cross-border tax disputes, we would have to refer to the decision that is to be made by the OECD. If there is a mechanism to be put in place, we'll follow that mechanism. If not, we already have some CDTAs with some jurisdictions, so we'll rely on those to resolve disputes. Chair, I only have a short follow-up question. Sure. From what the Permanent Secretary said, since we have different approaches to deductible expenses, when we're incorporating the globe model rules, it will become local legislation. So my point is, if we are adopting standards that are different from international standards, why can't we maintain some of our local standards? We are already implementing the framework of minimum tax, but then we already have a pretty good system for deductible expenses. Why can't we just adopt this system for deductible expenses? I think in a way companies may feel that they are misled, and that has something to do with fairness. I think since we have this hazard, it also challenge, it comes with opportunities. Why not have our version prevail? and then we would have good business with appeal boards, and we will show other jurisdictions or enterprises we are fair. I think you understand that the Inland Revenue Department representatives understand what you're saying, and I believe they will give you a very simple answer. We understand what Dr. Jonas Ho is saying, but regrettably, as I said earlier, with the implementation of this framework, we have to undergo a peer-review process. The OECD's requirements are quite clear. We have to follow completely the rules of the OECD. There shouldn't be any deviations. If we deviate from the requirements, there will be consequences and we may fail the review. For some of the jurisdictions that have implemented the framework, the OECD has already identified something in their legislation that would have the same approach, and they have requested changes to be made.
Next, Mr. Frankie Yik. I'd like to pick up on points raised by Mr. Edmund Wong and another member. Speaking on behalf of the business sector, there is a concern that there will be a de facto capital gains tax coming in the form of a top-up tax. Now, Commissioner, you already explained the two approaches to cushioning the effect. But if we adopt the cost model in accounting practices, then say for companies holding assets for 50 years, then it will be difficult enough to conduct due diligence checks in order to identify possible liabilities, for example. Now, you mentioned that many major enterprises in Hong Kong conduct valuation exercise on an annual basis. Now, let's say enterprises would like to adopt the valuation model at this point in time, but then they may be coming too late. Will it be possible for the implementation to be delayed just to give us a bit of time? Because as I understand, not many enterprises understand the real impact. So my question for the administration is whether there is room for a delay in implementation so as to minimize the impact as they conduct the valuation exercise every year. Thank you for the question. Now, about the sector's awareness, as you put it, of course, some enterprises may not be as aware of the upcoming practices as others, but that is not the case in general, because back in 2022, when OECD first floated the rules, some professional consultants already published reports and in these reports, they have come up with the two approaches I mentioned in minimizing the top-up tax to be paid. So, as I said in my opening remarks, many MNE groups have made the necessary preparations. To answer your next question, that is whether a new accounting approach can be taken so as to minimize the tax burden if the asset is to be realized in the future. Now, as I understand, the implementation date or the effective date is the 1st of January 2025, and some companies are in fact still preparing for financial statements for the financial year of 2024. So that means if they've adopted the approach I mentioned, then in 2025 they will be able to benefit from the so-called tax preferential practice that I mentioned. Right, thank you for the clarification. That means there is still time for the enterprises to adopt this more favorable approach, in other words. Now, let me now turn to Mr. Edmund Wong's point, whether we've conducted sufficient publicity to explain the low tax regime. Now, you said that there is no change to our low tax regime, but that's not true. Like Dr. Junius Ho said, if you want to attract foreign enterprises to set up presence in Hong Kong, the first question they ask is whether they make an annual consolidated revenue of 750 million euros, because otherwise there won't be any difference if you're not in scope. Now we still have members waiting to speak. Whilst we're on the topic, I will allow members to speak for another round. I'll give each member 5 minutes first. If need be, I will further extend this meeting beyond 4:45. Ms. Carmen Kam. We will be subject to a peer review after introducing the global minimum tax. I'll just throw some ideas around for members to consider. Now, you need to explain this punchline better, or the tagline better, and that is to say the global minimum tax is in place around the world. The countries need to fulfill the OECD requirement. So one way or another, you need to fork out money to pay the top-up tax anyway, and you better pay that money to Hong Kong. And the top-up tax will only be charged because of the BEPS 2.0 framework, and that indirectly, there is a question whether the profits will be counting to the calculation of a capital gains tax. Now, about other preferential tax treatments, such as aircraft leasing or patent box, we give tax breaks to these businesses. Now, during the calculations, we have the originally with the tax breaks, we have a profits tax rate lower than 16.5%. Now, and then taking all these concessions together, we need to be able to explain to others. We need to come up with crib sheets or infographics. Now, as I understand, say we have the main purpose test, and according to some professional bodies, after introducing this bill, things may be harsher for the taxpayers. So we need to find a way out. Now, one way is to whether there is possible further amendment to the bill, or whether we can perhaps massage the provisions a bit. The other point I want to make is about peer review. I didn't have time just now. Can you give us a PPT, a PowerPoint, to let us know what countries have passed the peer review? Next, I'd like to turn to the UTPR and That is the third rule. It will only come into effect on the date that's appointed by the Secretary for Financial Services and the Treasury. Now, I understand that this is the approach adopted by other jurisdictions such as Singapore because we don't want to get ahead of others in introducing the third rule. I think you need to explain this point as well. Right. We have responses to public views. We also have responses to the assistant legal advisors questions, and these are the responses to be provided by the administration. And you also mentioned the SWOT analysis. So this is another entry on their list of things to do, as well as some examples of peer review for illustrative purposes. So perhaps we should wait for their response papers at the next meeting. Deputy Chair, Mr. Edmund Wong. Now, my question is about accounting profits. Does it include is it included in the statement of incorporated income that is under the OCI? Is it something to do with the classification, share of JV, or the portion of exchange difference under OCI? I'm sorry, I really need to cite these terms in English. I'm just saying that we're giving a hard time to the translators or the interpreters. So for the things under OCI, as I mentioned, will it fall within the scope of total profit in calculating the minimum tax rate? Commissioner, I think you are the only one who can answer these questions here. Let me clarify. Is Edmund Wong asking about the 750 million euro or the calculation of the total profit? Now, for 750 million euros, we're talking about the total income or turnover. That means you're talking about the effective tax rate. Total profits include all profits stated in the financial statement. So your understanding is correct. For unrealized profits, and also other forms of earnings not in the books, does it mean that in the past they would not be subject to the profit tax regime, but now they will be subject to the top-up tax regime? That is true, because the basis is the earnings or profits set out in the financial statement. So for the unrealized profits, according to the accounting standards, they may be counted towards the calculation of profits tax or top-up tax. But there are also avenues available to these groups. Say, for example, if you take the market value approach in accounting, that is the increase of value because, the profits arising from increase in value, and that's one option for the groups. Now, without choosing this option, it is true that the unrealized profits may be counted towards the calculation of the top-up tax. But if the groups choose this option, then this is a way out for them. Another point to pick up on what Mr. Frankie Yik said, at the end of the financial year, usually in March this year, then the groups can still make adjustments to the books for the financial year 2024, but not so much for other entities making announcements before the 31st of March. Now, among the 200 MNE groups you mentioned, have you conducted any survey? Because today is the 5th of February. Of course, they can apply to the Hong Kong Exchange to avoid the announcement requirement, we do not have the survey. Right, I have another point of clarification. You mentioned FSIE, and it refers to a dividend income approach. FSI is a form of dividend income. For associated or affiliated entities, you need to deduct the investment costs, and only the remaining portion would fall under the P&EL. But now, does it mean that you need to deduct the investment cost first, and then you also take into account the dividend payout before doing the calculation? Because once you have the dividend income, they will be included in the calculation. That may be a difference.
Commissioner, I think there are two different concepts with the foreign source income exemption regime. Say for dividend income derived in mainland and one is receiving it in Hong Kong, if some conditions are not met, then it will be taxed. With the calculation of the effective tax rate, we would have reference to the profit stated in the financial statements, and that acts as a starting point. And the OECD's rules are very clear. If we're talking about a dividend income that is received and the company holds 10% or above in shares, then that dividend income can be carved out. I think, Mr. Edmund Wong, you're asking very specific questions, and I think for even some LegCo members or some members of public, they do not understand what you're asking. Perhaps you can write down your questions and submit it as a document to the Bills Committee. The administration can then provide a written reply, and then members can have reference to both the questions and the response given by the administration. It may be easier for members instead of just listening to what you're saying, because it may be hard for us to comprehend for members to comprehend the information. Sorry, Chair, I have something else that I want to say. Indeed, what I am talking about is quite technical, and that echoes the point that I made earlier, that we do not necessarily have a simple tax regime. We have zero taxes for family offices, and we also have different tax treatments for different things. And if we are adding another initiative for calculating an effective tax rate, it is a challenge, but then it also brings some opportunities to, say, the accountancy sector. But let me say this, the tax system is actually quite complex, so we really have to think about how we can do something in publicity to promote our competitiveness. All right, we already have another session reserved, and the next session will take place between 10:45 in the morning and 12:45 p.m. on 24th of February. The Secretariat will issue a notice to inform members on the arrangements for the next meeting, and perhaps we will also have the responses from the administration and more papers ready for the next discussion. If there is no business, meeting adjourned. Thank you.